Hey all, welcome to ShareTreck, where science meets investments, and I'm your host Raj. Friends, this week, the first week of September 2025, has already lived up to its reputation. Markets hitting record highs on the surface, while cracks are widening underneath. From weak labor data pushing the Federal Reserve towards the first rate cut in years, to tech stocks leading, but with fragile trend. This week has become a turning point that sets the stage for how September and maybe the rest of the year will play out. This weekend editorial focuses on what happened and what is about to happen in the next week. Welcome back, everyone. The first week of September 2025 delivered a potential mix of record highs, policy shifts, and cracks beneath the surface. A fitting microcosm of the market's current mood as summer gives way to autumn. Record highs mask underlying stress. Early in the week, tech and consumer stocks powered the S&P 500 and Nasdaq to new record closes, buoyed by strong performances from Amazon, Broadcom, and Meta. Alphabet's antitrust legal win also sent ripples of relief through the tech sector, temporarily overcoming September's reputation for volatility. But beneath the bullish price action, cautious undertones lingered. The Dow lagged as blue chips and cyclicals responded more sensitively to macro signals. What's particularly striking is the narrowness of the rally. While headline indices soared, market breadth told a different story. Fewer than 40% of S&P 500 stocks were trading above their 50-day moving averages by week's end, a classic sign of concentration risk that has historically preceded broader market corrections. The week's dominant story was the drumbeat of economic data culminating in Friday's pivotal jobs report. Labor market cracks appeared everywhere. Jobs openings hit pandemic lows. Weekly jobless claims ticked up. And Friday's non-farm payrolls disappointed with only 22,000 new jobs, well below the expected 75,000. Unemployment rose to 4.3%, the highest since 2021. Here's the striking context. Revisions showed employment actually shrank in June for the first time since 2020, painting an even bleaker picture of labor momentum. The 3-month average of job gains has now fallen to just 58,000, a pace that historically signals recession risk when sustained. Market focus snapped towards the Federal Reserve. Following Powell's Jackson Hole hints, traders began pricing an approximately 87% chance of a September rate cut with roughly 14% odds of a deeper 50 basis point moves if inflation data cooperates. With weak job growth now too significant for the Fed to ignore, equity buyers cheered bad news as good, expecting easier policy to extend the rally. The Fed's about face has been remarkably swift. Just 3 months ago, officials were debating additional tightening. Now they are contemplating the first rate cut since the pandemic emergency measures. A policy whiplash that underscores both the labor market's rapid deterioration and the central bank's reactive posture. And tech was both hero and harbinger this week. Gains clustered in mega cap names and AI exposed stocks, but cracks showed in underperformers like Salesforce, which missed revenue guidance and highlighted enterprise software spending fatigue. NVIDIA's post-earnings reaction was telling. It was tellingly muted despite solid numbers, a sign that even AI darlings faced increased tough comparisons. And investors have begun rotating away from high valuation tech to smaller caps and value plays, betting the next leg up will need broader participation. The Russell 2000's 3.2% weekly gain versus Nasdaq 1.8% advance signals this rotation is gaining steam. But history warns when markets depend on Fed easing rather than fundamental strength, rallies often prove fragile and prone to rapid reversals if sentiment soars. Trade policy and geopolitical shadows are also prominent. Market sentiment also had to digest the appeals court verdict questioning the legality of major Trump-era tariffs. While tariffs remain in effect pending further legal review, the uncertainty has added another risk layer to September's already fraught landscape, underscoring that political and trade headlines remain market-moving forces that could disrupt the Goldilocks scenarios investors are pricing in. What we are witnessing is a fascinating economic paradox. Record high asset prices celebrating the prospect of emergency monetary easing. This disconnect between financial markets at peaks and labor markets showing clear stress represents either the most prescient Fed pivot in years or a dangerous misreading of economic signals. Consider the historical precedent. The last time unemployment jumped from cycle lows to 4.3% this quickly was in early 2001 and mid 2007, both periods that preceded significant economic downturns. Yet, markets are treating this weakness as a buying opportunity, banking on Fed accommodation to extend the cycle indefinitely. So, what are we left with? A market at all-time highs, celebrating the prospect of Fed rate cuts, but with clear signs of macro fragility beneath the surface. The coming week presents twin tests that will determine whether September lives up to its volatile reputation. The first test is the inflation test. Consumer price index data will reveal whether disinflation has stalled, potentially forcing Fed into the uncomfortable position of cutting rates while price pressure persists. A scenario that historically ends poorly for both bonds and stocks. The second test is the breadth test. Can this market broaden its rally beyond the mega-cap tech names that have carried it to the new highs, or will the concentration risk that has built over months finally exact its price? With 87% odds of the September Fed cuts now priced in, the bad news is good news regime dominates market psychology. But this framework only works until it doesn't. Typically, when either inflation resurges or earnings disappoint badly enough to shatter the illusion that monetary easing alone can sustain asset prices indefinitely. For investors and observers alike, my message is stay nimble, diversify beyond the mega caps that have dominated returns, and watch for signs that the market's narrow leadership is finally ready to broaden or collapse under its own weight. The next few weeks will likely determine which scenario unfolds as we head into the crucial fourth quarter. The setup is as precarious as it is profitable. Trade accordingly. Friends, thanks for watching this video. If you have not subscribed, can you please subscribe and help grow the channel? This brings me to an end of the video and this editorial. I look forward to your comments and your feedback. Please put them in the comment section. I'll catch up with you in the next video. Bye for now.